Thanks for tuning into today's Talking Point. I'm your host, Neeraj Shah. The case for a chat for our guest today. Well, with crude prices looking the way they are and commodities in general, what's the impact on India? And is there a net positive because we are a commodity importing country? I think it's an important question to find out. Is power, is there a key in that space? And is power looking strong for the longer term? Will user growth fuel quick commerce, or is it internal metrics that could help that sector as well? To talk about all of this and more, Ramesh Mantri, Chief Investment Officer at White Oak Capital Asset Management, with us in the show. Ramesh, so good talking to you. It's been a while. Thanks for taking the time out.
Yeah, good morning, Neeraj. Pleasure.
No, the pleasure is entirely ours. Ramesh, how are you thinking about the current landscape? Because this opinion is divided right down the middle that we are expensive but not egregiously expensive. But at the same time, we are looking at, after 4 years of double-digit earnings growth, maybe a moderation in earnings growth as well. And could that impact the sentiment, if not flows? How do you think about it?
Yeah, we are seeing in the last 3-4 months significant slowdown in high frequency indicators. And one of the biggest reason has been the lack of government spending. Government spending fell by 19% in the first half of this year. And this is very unique. In fact, our fiscal deficit is running at 20-year low in the first half. So it's basically government has money, but it's not spending, which is not a bad problem. It's not a difficult problem to solve. If you have money, you can always spend. So that will help the economy. So that's creating a pressure point in the short term. It's also showing up in slower corporate tax growth. While personal tax growth is actually very good, but corporate tax growth has slowed down, which is an indicator of some slowdown in earnings. Yes, market valuations are about 10 to 15% now higher than long-term averages. There are pockets of exuberance, particularly on the smaller cap side. And there's a still relative value on the large cap side and in some sectors, while other sectors have a lot of expectations built into them. So it's a mixed bag. I think important part, we are not, I would say, significantly overvalued that we have to worry about sentiments and about things. So, and the good part is the two twin problems that India is seeing on the macro side. One is, of course, the lack of government spending and the fact that the rates are still high relative to inflation. Those are easily soluble problems. Imagine the opposite problem if the government didn't have money and we were running higher inflation. Then you can't solve either of the problems. But today, both the problems are soluble. And there is, of course, a certain tailwind in favors of India because of the geopolitics at work. So yes, when things are going to be good, the price is always going to be slightly more higher. You can't have fundamentals good and prices being lower. That really happens in markets.
But so Ramesh, okay, which is one part of the equation that the issues are not that big. I'm trying to think if the growth triggers are strong enough for Indian markets, whether it's the large cap indices or specific portfolios, to show very strong earnings growth as well as therefore capital appreciation. Is there a case for that, or currently it's in cricket parlance a swinging wicket and it's better to safeguard the wicket as opposed to try and make runs?
Yeah, so after 4 years of strong growth, this kind of growth in earnings is hard to replicate, right? We are getting some base effect in place now. And as I said, as economic indicators are slowed down, it will start impacting corporates. We are seeing even in consumer sector, a lot of fair amount of weakness. So yes, you're right, that one has to be, I would say, keep a balanced approach. One needs to now look at closely asset allocation, maybe start looking at keep a more balanced approach, avoid real pockets of exuberance, which are in small caps and micro caps and all, and be more tilted towards large caps. And avoid sectors with a lot of exuberance.
Oh, okay, avoid sectors with lots of exuberance. That would mean a lot of sectors. Ramesh, I'm trying to understand this. Okay, so let me try and understand first. Is the portfolio strategy a bit of a barbell approach wherein you're probably veering towards pockets of value, but at the same time, because you guys follow this approach, right, of having an opco and a finco, and therefore your valuation models are different than what the street might usually follow. So I'm trying to understand, how is it that you're building out the portfolio currently?
So see clearly, where we see opportunity is in BFSI, in pharma and healthcare. Uh, Technology, we are more neutral. We are clearly seeing, and then there are pockets of very high growth in India, which is basically, or I would say, a lot of tech-led businesses. Some of them have gone public in the last 3, 4 years in the markets, right, where there is very strong growth. And then there are strong pockets of growth, let's say in electronics manufacturing, on the power side, and of course, select jewelry retailers. And then there's a odd company like in apparel retailing that's growing like, you know, very difficult to understand in this kind of economic environment to grow at those rates. So those pockets of growth where the growth is very high in India, those of course, valuations while are not cheap by any measures, but still tolerable. While value is clearly there on the banking side, on pharma, on IT is also, if growth comes, value is going to be there in IT also.
Okay, that's interesting. Ramesh, a bit of a here and now there. The numbers, I mean, you can argue that TCS did one, HCL Tech did quite the other in terms of commentary, really, if you will, or maybe not so much. But the ISG data that came out overnight seemed to suggest that deal-making activity is actually at multi-quarter highs as well. And I remember conversations with even managements which said that some of their clients are saying that nothing till the elections are out of the way. The elections are 1 month away. Do you sense the possibility of even multiples or earnings or both seeing a thumbs up post the US elections are out? Can it be IT's year, calendar year 25?
Well, it's difficult to say this, that it is going to be an IT year or not. But one thing is there that, of course, US elections are an event and things tend to slow down. So I think irrespective of the US elections outcome, things will start moving from there. Remember, these companies fundamentally are leveraged to global growth, particularly on the US and Europe, right? So it's going to be a function of the economic growth. I am very clear technology is here to stay and become a larger portion of our lives. So all the changes that we're seeing, on AI and all the innovation that's happening will incrementally lead to more technology spending. It's then up to incubate whether each company, how are they placed. I would still say there are a number of mid-cap and small-cap IT services companies out of India who would still grow in double-digit dollar terms in this year. And that's where clearly
I think we've just lost that feed with Ramesh Mantri. We'll try and get that going in moments from now. If I can, I'd like to pull up some charts on our giant screen to just try and make a couple of other reference points. So we're talking about IT, and what I really want to know from Ramesh is what could the smaller size product companies do? Because we know about large caps and what they will do. What is it that the smaller size product companies will do is the main thing that I do want to understand from him. Do we have Ramesh back? Okay, I think we do have Ramesh back. Ramesh, can you hear me? You can.
Yes, I can hear you.
Perfect, Ramesh. So, sorry, if you're finishing your point, please make that point and then just tie it in with this question that I had, that while everybody looks at Nifty IT and looks at large cap IT, there are pockets of growth within the IT landscape, be it product companies, be it cybersecurity firms, one or two, etc., which are all showing some pretty good growth in the recent past.
Yes, so I would say that there are a number of mid-cap and small-cap IT services companies that will grow in double-digit dollar terms this year. And if growth accelerates, then some of them will start growing 20% or more in dollar terms. And then there are product companies which are also growing in the same ballpark. So we don't have to focus entirely on the large caps. In fact, the large caps invariably are the slower growing companies in the sector now for many years.
So avoid the large caps, that's the first point, or not avoid necessarily, you can do your own research, but Ramesh Mantri is saying that there are a clutch of broader end of the spectrum companies in the IT space which could be doing well and could be looked at. I mean, viewers, please do your own due diligence. The other one, Ramesh, is, before I get to manufacturing, is this whole thing around the capital marketplace, right? Because that bucket, last 3 months, commentary was clouded around regulatory action and what it could do. Somehow the numbers from whether asset management firms, broking firms, pipe companies, exchanges as well, has not been bad at all. And now it's a very widely listed and represented sector on the capital markets. How do you think about this?
I think financialization of savings and wealth management, right, is a mega trend in India. I think it's going to be good for a long, long time in India. So while there can be regulatory hiccups in the short term, I think the big underlying trend is very strong for a long time. So we believe there's a large opportunity in this space across a variety of business models that exist, from exchanges to asset management companies to service providers in the ecosystem. And remember, regulatory action was only focused on brokers and exchanges, not so much on wealth management firms and asset management companies. So this is a very broad, I think, fast growing. I would say India is where US was in the 90s in the financialization of savings. And you have a great, at least a couple of decades, great decades ahead of you.
Wow. So Ramesh, people lose sight of the woods for the trees, right? Would you, I mean, because things like this, when they turn, a lot of times, some things when they turn, at times people misunderstand the size of the opportunity and the length of the opportunity. I'm trying to understand, would you believe as things stand, and it could change, but as things stand, would you believe that that the opportunity size for financialization of savings and capital market related entities could actually be 15, 20 years? I mean, and things and firms can be materially larger than what they are right now?
I have no doubt about this. When I go on a train, a police constable asks me advice on what SIP to do, tells me how mass we are going, right? From trying to make a fixed deposit to, asking advice on SIP, tells me that's the potential. I think it's our, in fact, failure not to harness it enough, right? But the market is there.
Sure, and which is why maybe don't get perturbed too much by temporary falls. And by the way, there is a fall. I'm not saying it's temporary or permanent, but since you're on the topic of capital marketplace, let me quickly get in my colleague Harsh to tell us what Jefferies is saying about BSE, because that is a capital market link play, and that is down 6% today, because I presume of this Jefferies note. Harsh, what is the note saying?
Well, Neeraj, 6% lower today, but let that not perturb returns, because over the last 3 months, the stock has been a doubler. And Jefferies essentially suggesting that valuations have run up quite sharply. So calling out that particular point, they're suggesting that valuations have run up on the back of SEBI's new F&O framework, and therefore heightened expectations that the market has from the benefits accruing from this new and revised framework. In essence, the framework likely to hit around 25% of overall market volume. This is, of course, BSE and NSE combined. But BSE to actually benefit from this, is the market overdoing it? Jefferies certainly believes so. They believe that the valuation now implies a 40 to 50% share in weekly contracts, which is currently at 15% for the BSE. Need to wait and watch how H2 plays out, because that will hold the key. But Jefferies suggesting that 40 times price to earnings is the right way to value BSE. They've hiked their target price from 2850 to 3500. It's a downgrade from hold to an underweight, to an underperform. Now, in terms of the valuation itself, BSE at the top end currently was trading at roughly 55 times earnings. This is FY26 earnings at 86 rupees per share, just Jefferies estimates. And Jefferies therefore believes that valuations much more stretched, maybe 40 to 50% stretched versus what they are essentially penciling in. Of course, at the higher end of the curve, in their most bullish assumptions, Jefferies believes that 4,800 would be the fair price. But otherwise, target price that they've given, 3,500 with an underperform.
Yeah, well, a bit of a fall, but let's see what happens here. Now, let's shift focus. We have 10 minutes on the show. I'd love to understand from Ramesh about the India manufacturing story, because I know, Ramesh, that you've looked at opportunities, you've looked at businesses and the, not the renaissance really of manufacturing, that probably started 2-3 years ago, but there are a stellar number of companies which have made their presence felt by some unique manufacturing capabilities. Do you believe this sector also is here to stay? And while there might be temporary valuation or order flow led mismatches, the longer term looks strong?
No, I clearly believe, with India's, skilled labor and technical engineering skills, we are uniquely placed in value-added, manufacturing services. We have yet to get our act right at scale on the low-cost manufacturing, except in electronics manufacturing, where India has made a lot of progress. But say spaces like garmenting, toys, a lot of low value-added, we're yet to make a play. But in the high value-added space, which is I'm talking of complex engineered parts, aerospace parts, industrial items, already there is a lot of progress happening. Remember, unlike services company, which can rent an office and can go live in 3 months, hire people and go live, here you need to acquire land, get approvals, set up a plant, which takes 2 years, stabilize plant, and then scale up. So, any process takes a few years of scale up to happen. So it's usually a 3 to 4 year cycle before things start scaling up. But there is a lot of interest in India, more manufacturing to India. If you've been following stories, Germany has been rapidly losing competitiveness in manufacturing. A lot of plants shutting down in Germany across industries. And clearly there's a shift in manufacturing happening. I think on the value-added side, I'm very bullish about manufacturing in India. Apart from electronics, on the low value-added side, we have not seen a lot of success as yet.
Okay, so Ramesh, could you elaborate that point when you say value added, and you classified or clarified it by saying that there is some small value add happening in electronics, if I got that right, but you are saying that that's not all. There are other things to play in manufacturing on the value added side. Could you just give us some sense of what you're trying to say?
Yeah, so what I'm trying to say is, whenever India has to make, auto components, pharma chemicals, you to get into industrial items, whether it is in aerospace, defense, industrial parts, we are making a lot of progress across companies. And these are typically engineered items which require a lot of technical skills, and also, complex machining, right? Which is where India is making a lot of progress as we speak. On the low value added, which is basically assembly and labor intensive manufacturing, we've already seen a huge success in electronics manufacturing. The rapid scale up India has done in mobile manufacturing, TV manufacturing, and now it's moving to IT hardware. A few companies have done extraordinarily well even in public markets. But this story of manufacturing hasn't moved to other parts of the low value, labor intensive manufacturing, for example, garmenting and all, where we have not scaled up as yet.
Interesting. Ramesh, I mean, the other interesting thing was how, I mean, I've heard from so many people about some very niche manufacturing prowess in the country. I mean, the companies making unique products for even a Tesla or global aerospace companies, and that whole belt of manufacturing that has come up. It's quite stunning to see there. Valuations you don't think have run amok. You believe that there are pockets of value here.
No, so see, India is a growth market on manufacturing, so valuations are not cheap. I think some of these companies will scale up. I have seen companies which have added 5x capacity in one shot. Just imagine adding 5x manufacturing capacity in one shot. That tells you the market. So many of these companies today are constrained by manufacturing capacity rather than demand. So when you have that situation, you are okay to pay more higher valuations than situation where companies have to fight for demand.
Got it. Okay. I have two more things to understand from Ramesh. The last question I'm going to keep on consumer tech, food delivery and the likes. But before that, since we are talking about manufacturing, Ramesh, just drawing your attention here, and viewers, you can see this as well. This is the power play of India as per CEA and CRISIL and a consulting firm about what is the kind of capacity, installed capacity as of March 2024. Coal accounted for a lion's share. There was some bit of there in renewables as well, and large hydro. And look at what the belief is. Expected installed capacity by fiscal 2030. Coal share hardly moves up. What really drives up higher is renewable in a meaningful way, some bit of large hydro as well. Remember, nuclear doesn't become a large powerhouse until many years. Ramesh, how does one play this, if at all? Is this already discounted? Are there ways to play this whole push towards renewables that India has embarked upon?
First, I think energy is structural to growth. So any country cannot grow without per capita income, without significantly increasing per capita energy consumption. And the most efficient form of that is power. So power demand is growing, and India is particularly facing an acute shortage of peak demand power. And remember, renewables, because of their variability, cannot solve the peak demand power, particularly in the evenings in India when the sun is not there, and wind tends to be very variable. So you need alternate solutions. In the interim, we are still resorting to thermal because thermal, and nuclear capacity. But I believe the structural solutions, and there is also an attempt to build pump hydro. But remember, hydro are long gestation projects. So we'll continue to remain deficit in the evening market for some time. I think the solution will happen in batteries, grid scale batteries. Even in the last 3 months, we are surprised at the pace at which grid battery prices have fallen. And I think in 3 to 5 years, solar plus battery would start competing with thermal. So that is going to be really the long-term sustainable solution to power India. Now, the way to participate is many ways. I believe one simple way is to invest through power financials. Other, of course, is within there are, of course, a lot of capex is going to happen by utilities and a lot of growth is going to happen by utilities. But remember, this is going to be very capital intensive. So utilities have to keep raising money, both equity and debt, to grow. So I would actually play this space more through equipment companies where there is significant shortage. So whether it's transformers, conductors, cables, and then there is substations. So and of course, specialist EPC companies in this space. So within that whole power ecosystem, we'd like to play more through equipment companies and also through power financials and less through utilities themselves.
Less through utilities. I think that's a telling point too. So keep that in mind. By the way, speaking of that, just wondering if transformers and rectifiers completely off. I'm not saying Ramesh recommended it, but just look at that stock. Again, 3.5% higher. You heard the management a few days back and the growth prospects that they're talking about. Very interesting mover there. Ramesh, my final question is on consumer tech. And the whole conversation of what's happening in a flurry of notes around food delivery, for example, right? I just wanted to understand from you, when I go through notes on Zomato, for example, I'm not asking you to comment on Zomato, but when I go through notes on Zomato, most of them suggest that growth is coming in from GOV growth, while the AOV growth is kind of muted. So is it to say that growth, and that's the expectation. So is it to say that growth will come in from higher user base, or will the wallet share also expand? Because I would like to believe this is still a nascent industry. So why is AOV growth showing muted trends?
No, so if you have growth, average order values may not go so much in India, but actually revenue growth requires more. You see, growth happens because of 3 reasons. One is simple average order value going up, more users and more usage. So clearly in India, the potential for the markets to grow has to be on the more users and more usage. And the exciting story about the likes of these food delivery platforms is not so much now on food delivery, which should probably grow at 15 to 20% long term. I think the hyper growth is going to come on the quick commerce side, and where their business model is completely disruptive to the Kirana format, to the large retailers, of modern retailers, and also to the likes of Flipkart and Amazon. So this is really the game-changing story in these companies. And this quick commerce is a uniquely Indian business model. Probably it will get extended to some emerging market. It doesn't work in the Western world, but this is a very unique solution to the design of Indian markets and the Indian consumer, the needs of the Indian consumer.
Wow. Okay. In some sense, I love the business model because it also solves the issue of employment, right? People can argue all that they want about gig workers and their rights, etc. And all of that is important. But the point being that there is a large labor force getting employment, which I somehow love, Ramesh. I don't know how you think about it, but I really love it. The fact that
I
there
think
is
people
employment.
miss this point that actually it's creating a lot of jobs
Right.
because this is a labor intensive operation. So actually on a net basis, these companies actually end up creating more jobs than the other retail formats.
Yeah.
This is a very important point you talked about.
Yep. Okay. Ramesh, fascinating talking to you as always. Great data points. Thank you so much for speaking to us and to you and yours. Festive greetings. Hopefully we talk in and around the Diwali time.
Yeah, best wishes to everyone. Thank you.
Thank you so much. And viewers, that's it on this edition of Talking Point. Thanks so much for tuning in.